Your thoughts on how the year has shaped out so far, and your prognosis for the action going forward. Do you reckon that emerging markets can eke out some outperformance going forward?
Yes, good morning. So our position is unchanged. So we came out with our yearly outlook in late November, early December of last year, which took the view that the first half or thereabouts of 2019 was likely to be constructive for emerging markets in particular. In fact, equities as an asset class was sort of likely to do reasonably well during that time, led by emerging markets. But the second half of this year will be problematic as the markets will be discounting, a significant slowdown in the global economy led by the U.S. in 2020. So it'll be very much, a year of two halves. So our view is that it has been, again, since the end of last year, that in Asia we would be overweight emerging markets, in particular and ASEAN. Less positive on Korea and Taiwan, which were underweight, and underweight Japan in the context of the Asia Pacific, all of which would be affected by our negative view on technology, and also sort of more geared into the global trade cycle. We also made the call Q4 of last year, which was non-consensus at the time, that the RBI would be the first to cut rates in Asia during 2019, which turned out to be the case. So India is dealing very short term with some supply issues on the government bond side and near-term fiscal policy ahead of the elections, but we see that as only a sort of a short-term blip. Beyond that, we see that the rupee, along with several other currencies in Asia, particularly in ASEAN, such as the Indonesian rupiah, as well as the Filipino peso, will likely to be stronger throughout the balance of this year, supporting risk assets, including equities.
Paul, hi, good morning. So you said that the market is discounting the slowing global economic growth. Added to that is the lingering fears over the US-China trade talks as well. Put together, if the second half of 2019 is problematic, what kind of damage do you see in the markets, global markets that is, and where do you see the larger casualties come through?
So we see significant risks in equities. In fact, our view is that equities as an asset class will probably peak out for the cycle by the middle of this year, and then essentially multi-year bear market. So we think that there's a prospect in the second half of the year for emerging markets to outperform, but it's difficult to see much of a bifurcation in emerging markets beyond about a quarter or so. Just historically, that's never been the case. So our view is that in 2020, the US will be in recession by around the middle of the year. The markets tend to dip ahead somewhere between 9 months and 12 months, which means essentially we should be very cautious on equity markets by the middle of this year. There are some risks, and one of which has already been mentioned on your program, which is the potential for negative earnings surprise in the US. This is particularly at risk once the tax cut effect drops out, and so that base effect will make it challenging for earnings in the US. But to answer your question about where we see the major casualties, we see them largely in developed markets, and in particular, we would see risks in Europe as sort of being number one, but also potential risks in Japan.
Paul, more specific call on India. Where does it leave us here? This market on the index has been in a range of about 400, 500 points. Do you see a breakdown of that range? We're right now at the top end of it.
Right. So I'm not a short-term trader. I'm an equity strategist, but I'll try to answer your question to the best of my ability. We have a very large overweight in India, in Morgan Stanley Asia ex Japan, with 14% versus 10.3%. And on our scorecard, India scores poorly on valuation, but it scores extremely well on earnings growth, which is well above the region at around 22% this year versus less than 10% for the region. We see further scope for easier monetary policy this year because the policy rate is still well above inflation. And, given the outlook by the RBI of around 2.8% for this year, there's certainly scope for rate cuts. Fiscal policy is still accommodative. So we think that India is our top pick for 2019, and we see the prospects for emerging Asia being good, particularly in the first half of this year. So we do see some decent upside. So we don't really sort of see India breaking down here. I'm not a charter, so there might be some other people who are better than that than me. But from when we look at our sort of fundamental matrix approach using valuation, earnings, macro, and policy, we see India being actually quite well underpinned.